median returns have been great. A lot of the studies around PME, the alpha that private markets have over public markets, when using the median level of return, has been very attractive. So private equity has been great. We are highlighting very much the fact that the average, the cash flow weighted average, sometimes referred to as the pooled return, as disclosed by the many data providers out there today, has had a consistent alpha over that median. And if we look at the last 20 years, it's more than 300 basis points average alpha over the median. And that's because what I think people do appreciate very much, that in private equity fund level returns, very similar to pretty much most other asset classes, you have a right skewed distribution profile to the level of returns. So if it was a normal distribution, average and median are the same. The moment you have a right skewed distribution and you have some phenomenal outlier winners, it makes it really exciting. And the whole active part of the strategy, picking which fund is going to be the best fund this vintage year, is highly valuable if you get it right. And there are some amazing, phenomenal alpha generating strategies out there that really perform phenomenally well. They really help bring the average up. The thing is that statistically, what we found, approximately 70% of funds in any vintage year in private equity end up being below the average and 30% being above the average. And so being able to just get that average to basically sleep well at night and consistently year in, year out, deliver that average level of return for private equity, the pooled level of return, which has got a great premium over the median, is, I believe, very attractive, certainly on a risk-adjusted basis. And I can get into a bit more detail on some of the, call it quasi-academic research that we've done, which can make the case even more strongly.
Well, that you said year in, year out, and that's part of it, isn't it? Because you might be able to beat the average once or twice, but on a consistent basis, presumably it becomes increasingly difficult to do.
I think that's exactly the point that we delicately have tried to showcase. At least we've looked at those investors, those LPs, allocators that make their private equity returns publicly available over a long period of time with 20 years of data. So we looked in particular at the US public pension system. And you have well over 50 of those US public pensions that have that 20 years of historic data. And what we found is that in any one year, roughly 1 in 5, maybe 3 in 10, on their portfolio basis, have outperformed the index, the pooled return. But nobody, there was one that seemed to do so consistently over 10 years. Only one out of the 55 that we analyzed. Everybody else sometimes got it right, sometimes got it wrong, and more often than not ended up getting it wrong.